How's everyone doing? So here, a little quick. So here's the million-dollar question, right? Can the bull market continue? And this is something that we do a lot of research on and review and analysis as to where do we think we stand. And one thing with economics and markets is that it usually goes in cycles, right? So what you need to know is where do you stand in that cycle and what does the data support? So let's go through here. Go to the next one. So Sir John Templeton, does anybody know Sir John Templeton? Know the name? So very famous investor from the 20th century, became a billionaire with his fund, Templeton Growth Fund, and he was both a British and American investor. He had a quote that helps explain the market cycle. So bull markets are born on pessimism, grow on skepticism, mature on optimism, and die in euphoria. Right? So all this means is when things look really bleak, like 2009, that's the beginning of a bull market, right? And it goes on there as investors start to get confidence that, hey, maybe this bull market's real, the economy's strong, and it continues to go till at some point you hit euphoria, right? And that's certainly in 2000, you saw that with the tech bubble. But it can vary, right? So we didn't see that in 2007, but you had other bubbles that existed. So you had a commodities bubble, you had a financial and housing bubble. But really, this is a cycle that, you look at history, there's some element of this that exists in the market. So Liz Ann Saunders, she is the chief investment officer at Charles Schwab, and she has a different take on this quote. So this is talking about this bull market, was born on despair, grew in disbelief, maturing on skepticism, and may die on acceptance. So her point here is this has been a bull market that from the very beginning most people did not believe in. And it continued to be the case. Matter of fact, sentiment has been one of the biggest issues, both investor sentiment, consumer sentiment, and business leader sentiment, right? And that's a problem with having the economy continue to grow. And that's why the Federal Reserve has been so slow in raising interest rates, because if sentiment's not there, you're not going to have this dynamic nature that you need to exist in the economy to have real sustainable growth. So, you know, I would say that certainly we're still in the area of skepticism. Let's go to the next slide. So I think this slide kind of points out something that Ryan mentioned and really shows that some of that skepticism. So what it's looking at is flows from 07 to 2016 into 3 different asset classes, right? So the green line that is really taking off there, that's flows into bond funds. $1.6 trillion going into bond funds. This is going on at the same time that we're in the second longest bull market in history. People are flowing money into fixed income, into bonds. The gray line, which is equities or stocks, has started to come into its own since 2013, but you can see for 4 years through the beginning of 09, it's really low flows into equity funds, which would be a great time to be putting money into stocks. But as Ryan mentioned, quite often people, investors are doing all the wrong things. But it's not until recently when some of that money has gone in. But you can see even now in the last year, there's really been a tick up in bond flows, but not necessarily in stocks. So you still have that sentiment. There's still a lot of skepticism that exists as investors. And then the last one, the multi-asset, that's basically either alternative investments or with like a balanced fund. It seems some growth, but nothing substantial. So really what you're looking at is the stocks and the bonds. And what that shows me is there's not a lot of positive sentiment out there from an investor perspective. Okay, so why are we optimistic? So let's go first reason, and this is really one of the biggest, right? You know, we may have a 10% correction in the market, right? We saw that last year. That is very common in any bull market. In 2011, we had a bear market correction, right? We were down 20%. That's a bear market correction. That can happen in a bull market. But it doesn't change the fact that we're still in a bull market, meaning that the general trend is up. And what we would say is we are in a general bull market right now. So one element is there any risk of recession? And when we look at the data, there's nothing that stands out that says, hey, there's some elements here of risk, right? You know, it doesn't mean that there's a zero odds of a recession. Everything in economics and finance is percentages. We think the odds are still low. We think it's 25% or less. So we think that the fact of something happening is very low, both in the US and globally, that could flow back and hurt us. The next is consumer consumption, and this is probably one of the biggest elements, and we'll go into detail as to why we think this is so important. But Ryan mentioned the importance of rising wages. The consumer makes up 70% of GDP. So if you can get strength in the consumer sector, and in particular by having more people working and making more, it's going to be very positive to the economy. Now, it doesn't mean that there's not some major structural issues to the American workforce, and that is certainly a reason why Donald Trump was elected, right? There's a lot of frustration, a lot of people who are underemployed and not in the jobs they should be. That is one of the factors of working in a global economy, when your job can go overseas very quickly. We'll have to see as to what changes can be made to help mitigate that situation. But the overall economy, relatively speaking, we've got a very strong economy when it comes to the consumer and the labor markets. So next thing we're going to be looking at is valuations, right? So we want to make sure that valuations seem very reasonable. We don't want to be in a situation where valuations be very high. And I'll show you that, where that happened was in 2000. Valuations got very high. You're paying an awful lot for $1 of earnings with corporations. Right now, valuations are very reasonable. The other is in 2016, earnings turned positive. So we actually had what's called an earnings recession last year, and that was really in large part driven by the negative earnings coming out of the energy industry, in particular with the decline in oil. But right now in the fourth quarter 2016, we actually had positive earnings for that quarter, and that's really a big part why the stock market's done well. Now, part of it is expectations of what's going to come with Donald Trump, but the other part is we're really seeing some strength in earnings. And at the end of the day, as investors, that's what matters, is what is current earnings and what are expected future earnings. That's what it comes down to. And right now, we're seeing positive earnings for the fourth quarter, and things are looking pretty good as we look for 2017. Okay, so corporate tax rates. So there's the whole broad spectrum of what could be coming from a policy perspective. There's a lot of unknowns out there, and so it's very difficult for us to manage portfolios based on what could happen. But the fact of the matter is, even if just some of this can happen, and there's some element of compromise, because for a lot of this, you're going to have to get some Democrats on board in the Senate to make it happen. So if you can get some compromise on infrastructure spending, making sure that the deficit doesn't go up too much, some reduction in corporate taxes, this is all positive. The one element that has definitely come out of this, as far as with Trump being in office, is stronger consumer and corporate sentiment. It is, whether or not you like him or you hate him, whatever the case may be, the fact of the matter is corporations and even small business owners have a more positive sentiment. And that's a powerful thing when it comes to spending some of their cash. Healthy corporate balance sheets. So we're going to be talking about balance sheets, both corporations and individuals. Basically, they're looking pretty good. And all that means is assets are increasing and debt is decreasing. So that's a good thing. That's a good position to be in to have future growth. So I talked about GDP. So this is one of the terms we have on there, gross domestic product. Basically, this measures what the U.S. economy produces in any given year. So you can imagine all the different factors that come into play here. What you can see that really stands out is this is consumer consumption, right? Almost 70%. When you add in housing, it's over 70%. So if the consumer's healthy, it's going to really impact the GDP in a positive way. The other element that probably would be okay is government spending. We could see some increase in the federal level, which could be positive. But this piece right here has really not been growing that much, investment ex housing. So this is corporations investing in capital, whether it be capital for new equipment, whether it be something, a new factory. They have not been replacing capital in the way that it needs to be because it actually depreciates, right? If you have a factory, over time, it depreciates, so you got to reinvest. And if you look at the capital investment schedule, it has been way behind. So this is one area where we could see decent growth that has not been there. Again, another element that Ryan mentioned. So this is looking at wage growth. So what you can see here in 2007, 2008, real strong wage growth, right? 3+%. And then 2009 hit, the recession. From 2010 to 2014, you're at 2% wage growth. And what that means is you're basically just barely keeping up with inflation. So really, there's going to be really no way you're going to have a lot of dynamic growth in the economy when your workers are just making a little bit more to pay for the same goods and services they were getting last year. So that becomes a real problem. And as Ryan mentioned, over the last 2 years, we're starting to see wage growth. And again, it's a good sign that corporate balance sheets are in a good, healthy position, that we could see more wage growth over time. We want to get more in the 3.5% range, and that could be a big stimulus to the economy. Okay, so we talk about balance sheets, and again, there's another term that's on your sheet. Basically, with the balance sheet, we're looking at assets minus debts or liabilities, right? So the balance sheet for consumers is very good. This is basically showing debt levels, and it's from 1980 up to the current. And what you can see is, relatively speaking, we're almost at all-time lows. This is as a percentage of disposable income. So it's looking at debt versus how much income people have. And relatively speaking, debt levels are very reasonable. They peaked in 07, right? Everybody's taking out crazy mortgages to buy stuff and finance homes they couldn't afford. But now, since then, people have been saving, and that has been a negative to the economy, right? So instead of financing more consumption through debt, they've actually been saving more. So it was actually a drag on the economy, but now they're in a position where they're not going to be having to save as much. Who knows? They might take on a little bit more debt, right? And we don't want them to get back up to this level, but if they have a little additional debt, it can be positive to the economy. They're certainly not in a precarious situation. Net worth, right? So this is looking at assets minus the liabilities. You can see that over time that's been increasing. It hit a peak in 07, but since then has been rising. And all this is people, they're really doing a great job paying down debt. They're doing a great job in building assets. Their housing prices have recovered. So overall net worth has increased, and that puts the consumer in a very strong position. Okay, so we talked about valuations, price to earnings ratio, right? So that's another term that is on your sheet. This is basically saying the PE ratio is saying for $1, how much earnings you're going to get, right? So a PE of 16 means you're going to have to pay $16 to get $1 earnings per share. All this is per share, right? So that just gives you a good idea as to, is the market overpriced or underpriced? This dotted line right here is the average PE, price to earnings, over time. And what you can see is, certainly in 2000, things were very expensive, right? So everybody felt good. Their balances were up high. People knew how to buy stocks, buying tech stocks, telecom stocks. But the fact of the matter is, they were buying it at very high prices, right? Paying way too much for earnings that never came through. Whereas in 09, things were very cheap. Right now, we're at average earnings, and all that tells us is, hey, if we can continue to see earnings increase, the valuations are decent. It could be a possibility that you could actually see that number go up, that the valuation go up, even up to 20. It wouldn't be too outrageous, but what we want to make sure is it doesn't get too high, right? Because that goes to a point where we can start to say, hey, this is a risk element that we really want to be concerned about. Right now, we're not concerned about it at an average PE of 17. And then we'll also look at earnings. So this is what I talked about earlier, which is this is year over year earnings change for the S&P 500, right? And what you can see is 2012, 13, 14, all positive year over year earnings growth. Then you hit last year, flat, negative, 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 and then finally for fourth quarter 2016, we were positive. So really what that was is almost entirely from energy, right? Almost entirely from oil prices collapsing. So you both had oil companies just get decimated. They went from real positive earnings to negative earnings. And you also had oil equipment suppliers also get decimated. But now with oil around $50-some a barrel, that market is stabilized. And so that is not going to be a headwind that you saw before. And even last year, all they had this going on, earnings in general are pretty decent. It just was one sector just wiped out everything else out. So, expectations are right here. You could see some real positive strength in earnings. The only other headwind that is out there that is kind of unknown is, well, there's two. One is the strength of the dollar, right? So if you've got a real strong dollar, it's going to limit some of your ability to sell overseas. And then the other is increase in labor cost, right? So if we have high inflation, it could impact the bottom line for companies. Okay, so we're not going to go into too many details as far as policy with Donald Trump, but I think this one is really interesting. So what this is looking at is corporate tax rates. And there's two kind of elements to look at for each one of these countries. The green diamond right here is what the rates were in 2006, right? So you can see that we're at 39%. Now that's combined federal, state, and local taxes. And you can see that a lot of other countries like Germany, Japan, Canada, Korea, UK, they were in that range, right? Fast forward 10 years, we're the only one that's still up there, right? We're still at 39%. All these other countries that you would think would have a higher tax rate on corporations than we do, they don't. They actually have a lower tax rate. That's why you have corporations moving to Ireland or other countries and combining with foreign companies in order to avoid paying taxes. So again, this is one of those things where it doesn't have to, you don't have to be a Democrat or Republican. You look at this and go, okay, something needs to change here, right? And it just comes down to, can there be a compromise that gets it to work where you can get this corporate tax rate something more in this neighborhood, right? I think last night he was talking about 15%. Probably not going to be 15, but hey, if we get it to 30 or 25, that's a dramatic change. So the elements with this is it improves profitability. The other thing with this is there's close to $2 trillion in cash that's sitting overseas, right? That cash is just sitting there, you know. It's probably not getting invested the way it should be. If that cash can be brought back to the U.S., it'll be huge, $2 trillion worth of cash. So, you know, again, we don't know exactly what's going to happen from a policy perspective, but if we can get just some of these elements in place, it's going to be really positive to the corporate environment. And then finally, we talked about balance sheets. So we talked about personal and family balance sheets, corporate balance sheets as well. And I know we've been talking about this for a number of years, of the cash that's available and on balance sheets. And you know, the fact of the matter is we've been talking about it because it just continues to stay up at elevated levels. I mean, this is since 2000, and you can see it's still at very high levels. So what this is, you know, these companies can then use that cash to either do what's called stock buybacks, right? So all that is when a company goes out into the market and buys back its shares so that the earnings per share goes up, right? So that really is not a great use of cash, at least from many people's perspective, because all it's doing is increasing earnings per share by lowering the number of shares out there. The other element is it could do a dividend, which is good. We love to have ETFs that provide dividends. That's another thing it could do with its cash. It could also buy other companies, which can be good or bad. You know, there's plenty of examples of companies that had a lot of cash and went out, bought companies. It didn't work out so well. The two elements that have not really been happening, as I mentioned, capital investment into their stock, into their equipment, technology, all those things have not been happening. And the other element that's only been happening in the last 2 years is increasing wages and hiring more folks. So, you know, that's two other areas that we could really see some movement in. Okay, so talking about cycles, I think this is really important because when you look at different asset classes, they go in cycles, right? That happens, and being patient is very difficult as an investor, right? We tend to want things to happen when we want it to happen. What this shows is from 1971 up until the present, the cycles that exist with the MSCI EFA, which is Developed International Index, and the S&P 500. So what it's showing is over this period of time right here, from 71 to 73, so that's a 2-3 year period, the MSCI EFA had outperformed the S&P by 60%, right? So fairly dramatic outperformance by international over US equities, and that's the S&P 500. Then you see it rotates, right? Now we're the S&P outperforming 33%. Going back to the next cycle, MSCI EFA. S&P, MSCI EFA. And what you can see is it can be dramatic, right? Almost 400% that over this period of time from 82 to 89, developed outperformed US. So, but unfortunately, the last, from 2007 to 16, the S&P 500 has outperformed. And I say, unfortunately, just to the extent that if you've had it in the portfolio, and we believe in being diversified from a global perspective, it's been a laggard, right? It's underperformed by 85%. But the thing to remember is we could very easily become into a situation that we're in here, right? We're in this period of time where now the MSCI EFA outperforms the S&P 500 for 5, 7, 10 years. It's very difficult to say. Anybody saying that they know what's happening with it, they're not being honest with you, right? So the important thing is being diversified and being invested for the long term. We are underweight both with Europe and international, but we will never, as Ryan said, time the market and get out of an asset class completely, because guess what? We'll probably get it wrong, and that's when it's going to start doing well. Okay, another cycle here. Now we're talking about emerging markets. And what this is looking at, so there's two time periods here that are shown on the bottom, right? From 1988 to 2003, that's in the blue, and from 2004 to 2019. All this is saying is there's periods of time, like from 88 into 95, and from 2004 to 2011, where emerging market stocks outperform developed, right? You see these cycles right here. And then guess what happens? Just the opposite. Emerging markets underperform, right? So now we're coming out of a period in 2016 that were probably more on this upswing. So, I mean, last year was a great year for emerging markets, right? When we were sitting here last year talking about emerging markets, China, it would have been easy to say, hey, I don't want any emerging markets in my portfolio, right? Nothing good can happen. And guess what? It's the best performing asset class last year, or just about one of the best ones. Same thing with this year. It's doing really well. It's up 8% as we start. So again, we think that emerging markets could outperform developed, but we think that international in general can get into a cycle where it outperforms U.S. equities.